Using the pip package manager, the following Python libraries and their dependencies are being installed. 1. Pandas provides technical analysis indicators for pandas. 2. KiteConnect offers a Python client for ZeroDha's KiteConnect trading API. 3. ZeroDha used for statistical data visualizations in Python. 4. Koflinks binds Plotly directly to pandas DataFrames. 5. Sklearn provides tools for predictive data analysis. 6. Finance facilitates downloading historical market data from Yahoo Finance in a reliable, threaded, and Pythony manner. Installing these libraries is essential for utilizing their features in Python projects related to data analysis, machine learning, and finance. Installing through pip ensures that all necessary dependencies are also installed, simplifying the process of integrating these libraries into your Python code. By utilizing the Python package manager pip, this command downloads and installs the Python-docx library. This library enables the manipulation of docs files, which are documents generated in Microsoft Word. With Python-docx, developers can programmatically read, write, and modify Word files through Python code. This functionality proves valuable for automating tasks such as generating or handling Word documents in Python projects. To install the Kaleido package, a Python tool for capturing static images of interactive plots generated with libraries like Plotly. Use the pip package manager. This tool enables you to export Plotly visualizations as high-quality static images such as PNG, JPEG, and TIFF formats. By adding Kaleido, you can create static images of interactive plots for reports, presentations, or websites that don't require interactivity. This code snippet imports multiple Python libraries for the purposes of data analysis, visualization, and logging. 1. OS used for interacting with the operating system. 2. JSON enables working with JSON data. 3. PyTs facilitates working with time zones. 4. Logging sets up the logging configuration. 5. Requests allows for making shut requests. 6. NumPy Pand is essential for numerical and data manipulation tasks. 7. Pandas, a technical analysis library based on pandas. 8. Plotly specifically imports Plotly graph cogits for interactive plots. 9. ZeroDha, a data visualization library for enhancing aesthetics. 10. Matplotlib specifically imports pyplot for creating Python visualizations. In addition, specific functions like print from the print module, KiteConnect from the KiteConnect module for API connectivity, and datetime, time delta, and time from the datetime module for date and time operations are imported. The code snippet also contains logging, basic config level logging, debug, which configures the logging system to output log messages with a level of debug or higher to the console. Importing these libraries is crucial as they offer functionalities for data processing, analysis, visualization, logging, and API connectivity. These functionalities are commonly required in various Python projects, especially in fields such as data analysis, machine learning, and finance. The following code initializes the Plotly and Koflinks libraries for use in a Jupyter Notebook environment. Specifically in Google Colab, each line performs the following actions. 1. Import the version number of the Plotly library. 2. Import the Koflinks library, which enhances Plotly for easier use with pandas DataFrames. 3. Import essential functions from Plotly for offline plotting. 4. Initialize Plotly for offline mode in the Jupyter Notebook Colab. 5. Configure Koflinks for offline use in the notebook. 6. Import the Plotly input-output module for interactive plotting. 7. Set the default renderer for Plotly plots to be compatible with Google Colab. This code prepares the environment for creating interactive plots using Plotly and Koflinks in a Jupyter notebook. Particularly in Google Colab, it sets up the necessary configurations to enable easy creation and visualization of interactive plots within the Colab environment. This snippet of code utilizes the Finance library to fetch historical data for the 10-year Treasury note yield, commonly used as a proxy for the risk-free rate in financial models. Here's an overview of how it operates and its significance. 1. The Finance library is imported as if. 2. The ticker object is instantiated for the 10-year Treasury note yield with the symbol KiteConnect. 3. The history method is then invoked on the ticker object to retrieve historical data for the bond. 4. Historical data is fetched for the entire available period max. 5. The closing price data from the historical bond data is extracted. 6. The most recent closing price is divided by 100 to convert it to a percentage, representing the risk-free rate. This code serves the purpose of obtaining the current risk-free rate, a critical factor in various financial models and computations such as computing asset expected returns, the capital asset pricing model (APM), and valuing options. By automating the retrieval of this data from Yahoo Finance through Finance, the code ensures that the risk-free rate utilized in financial analysis remains current and precise. This code snippet establishes the required credentials and parameters for interactions with a financial trading data API. The provided credentials dictionary includes user-specific details such as the broker, user ID, password, and API key essential for making requests to the financial trading API. It then assigns the corresponding values from the credentials dictionary to the global variables users ID and API keys. Additionally, it initializes variables like instrument, start date, end date, and time period. These variables likely define the specifics of the financial data required from the APIs. This code segment plays a vital role in managing user authentication and configuring the parameters for making authenticated requests to the financial trading APIs. By organizing the credentials and parameters in this manner, the code ensures that the necessary information is accurately set up and prepared for use in subsequent API communications. The following code snippet uses the requests library to send a post request to a specific role, likely a ZeroDha API endpoint, sending credentials and a JSON payload. After receiving a response, it verifies if the status code is 200. If successful, it extracts an access token from the response JSON and assigns it to the access token variable. Subsequently, the code utilizes the KiteConnect library to create an instance of the key object. Using a provided API key, the obtained access token is then set on the key object for authentication purposes. This script enables authentication and access token retrieval from the ZeroDha API using the provided credentials, facilitating authenticated requests via the KiteConnect library. The access token is crucial for secure communication and accessing protected resources on the respective platforms. This script utilizes the KiteConnect API to retrieve the instrument token for a specific instrument. The process involves creating a KiteConnect instance with an API key, setting the access token, defining a function called getToken that accepts an instrument, fetching the latest price of the instrument by calling Instrument, capturing the instrument token from the response, and lastly, returning the acquired instrument token. The instrument token is crucial for securely interacting with the KiteConnect API, as it serves as a unique identifier for tradable instruments required for various operations like order placement and accessing historical data. The following code defines a function called createDate, which subtracts 90 days from a specified date year, month, day. It iterates through a range of 90 days by decrementing the day value. If the day reaches 0, it decrements the month and sets the day to 30. If the month reaches 0, it decrements the year and sets the month to 12. The function then returns the resulting date. The code initializes a list called dates with a single date 2022-11-15 and then iterates 48 times. During each iteration, the createDate function is called with the last date in the dates list, and the resulting date is appended to the list. This process effectively creates a list of dates that are 90 days apart from each other. This code can be beneficial in scenarios where a series of dates that are a fixed number of days apart need to be generated, such as for scheduling tasks or collecting data at regular intervals. It simplifies the task of calculating dates based on a starting point and the specified rules for decrementing days, months, and years. This Python function retrieves historical data for a specified financial instrument for a given set of dates by utilizing the getData function. It begins by defining start and end dates based on specific time values and then collects historical data at a 5-minute interval using his HistorialData function, storing the data in a pandas DataFrame named UnConf. The function then iterates over the input list of dates excluding the first date, computes start and end dates for each date, and retrieves historical data for the instrument within those dates at a 5-minute interval. Each dataset is stored in its own DataFrame diff, which are then concatenated together using ed onAt with the ignores and extrude parameter to create a single combined DataFrame encompassing data for all specified dates. Ultimately, the function returns unhandif, containing the historical data of the instrument across all provided dates. This code streamlines the process of fetching historical financial data for analysis or modeling needs, automating the data retrieval for multiple dates and consolidating them into a structured dataset for easier analysis and manipulation. This code appears to retrieve historical stock data for a specific selection of dates and instruments by calling a function named getData with two parameters, dates and instrument. Within the getData function, the stock data for this specified dates and instrument is likely fetched from a source such as a database or an API. This data may be returned in a structured format like a DataFrame or a list of dictionaries, which could then be stored in a variable like stockStuff. Utilizing this code allows for the automation of fetching and handling historical stock data, which streamlines processes like analysis, modeling, and visualization. This automation saves time and effort compared to manual data retrieval and manipulation. This code manipulates a data frame called stockStuff by adding two new columns, year and day. The year column extracts the year part of the values in the date column using the year attribute of datetime objects. The day column initially contains the open values but later updates them based on the weekday derived from the date column using the weekday function, which assigns a numerical value to each day of the week: 0 for Monday, 6 for Sunday. The purpose of this code is to extract specific information, such as the year and day of the week, from a day column. The extracted year can be useful for trend analysis, while the weekday information may shed light on stock market behavior on different days of the week. This code uses pandas to rename the date column to datetime in the stockStuff data frame. The rename method facilitates modifying column names directly within a data frame. By specifying in place true, the modifications are made directly to the original data frame without generating a new copy. This approach is beneficial for ensuring uniformity and clarity in column names, as well as aligning with specific naming standards across various datasets or for subsequent analysis and operations. Renaming the date column to datetime serves to provide a more precise representation of the information stored in that column. The following code snippet utilizes the head method from the pandas library to display the initial rows of a data frame named stockStuff. By default, this method presents the first 5 rows of the data frame, but you can specify a different number of rows to display within the parentheses. This function is convenient for swiftly examining the data frame's structure and reviewing its contents. It offers a glimpse of the data, encompassing column names and values in the initial rows, facilitating a better grasp of the dataset when dealing with vast datasets. Using head proves to be advantageous since it provides a rapid overview without necessitating the display of the entire dataset. Importantly, it is essential to note that this method is solely utilized for exploratory purposes and does not alter the original data frame. The following code defines a function called orb which takes a data frame as input. The function calculates the profit percentage of a trading strategy known as Opening Range Breakout orb. Here is an overview of how the code operates. 1. It initializes variables for balance actual money, equity stocks, range roof, range floor, stop loss, profit margins, and a flag. 2. It loops through each row in the data frame to analyze stock price movements at various times during the trading day. 3. At 9:15, it sets the range roof, range floor, stop loss, and profit margins based on the opening and closing prices. 4. It then verifies if the stock price breaks out of the opening range above the roof or below the floor and adjusts the equity accordingly. 5. If the stock price hits the profit margins, it updates the equity, resets the range, and flags. 6. Finally, at 3:30, it settles any open positions based on the flag value and calculates the profit percentage using the initial balance and final equity. This code is valuable for backtesting trading strategies and evaluating the potential profitability of the opening range breakout strategy. By simulating trades using historical data, traders can assess their strategy's effectiveness and make well-informed decisions when trading in real markets. This code snippet is likely designed to calculate and display the total return of the opening range breakout strategy for a given stock data frames. The orb function is a custom function that computes the return based on the opening range breakout strategy, where stocks are bought when their price surpasses the high or low of the initial X minutes of trading. The stockStuff variable is presumably a data frame containing stock data like open, high, low, and close prices for a specific stock over a duration. By using the format method, the return value obtained from the orb function is inserted into the output string. enabling the dynamic presentation of the total return. In essence, this code appears to be beneficial for assessing the effectiveness of the opening range breakout strategy on individual stocks or group of stocks. Through the calculation and presentation of the total return, traders and investors can measure the success of this strategy in a quantifiable manner. The following function, yearly analysis, is designed to take in a DataFrame diff as input and generate a yearly report dictionary as output. 1. A range of years from 2015 to 2022 is initialized. 2. An empty dictionary yearly report is set up. 3. An empty data frame temp is created. 4. The function loops through each year in the defined range. It filters the input data frame diff to extract rows matching the current year in the year column. The index of the filtered data frame is reset. The index column is dropped from the data frame. The orb function is applied on the filtered data frame to compute a result, stored in the yearly report dictionary with the year as the key. 5. Finally, the function returns the yearly report dictionary containing the analysis results for each year. This function is valuable for conducting annual data analysis on a given data frame by segmenting data for each year and running computations using the orb function on each subset of data. The following line of code is invoking a function called yearly analysis and passing a data frame called stockstuff to it. It is expected that the function yearly analysis would take the stock data from the data frame stockstuff, process it, and generate a yearly report or analysis based on the provided data. The exact nature of the analysis may vary depending on the implementation of the function. By structuring the analysis within a reusable function such as yearly analysis, the code becomes more modular and easier to maintain. This approach enables the replication of the analysis on different datasets or within various sections of our codebase without the need to duplicate the analysis logic. The outcome of this function call is then stored in the variable yearly report. The following function, day of the week, is designed to process a data frame diff. It groups the data in the input data frame based on the day column, which is assumed to include values representing the days of the week. The function initializes a list containing weekdays Monday, Tuesday, Wednesday, Thursday, Friday, and an empty dictionary day report for each weekday in the list. The function filters the input data frame diff based on the respective day, resets the index of the filtered data frame, removes the redundant index column, and then applies an unknown function orb to the filtered data frame. The result is saved in the day report dictionary with the corresponding weekday as the key. Ultimately, the function returns the day report dictionary containing the outcomes of applying the orb function to the data for each day of the week. This code is essential for analyzing and generating reports based on various weekdays. It facilitates data summarization for each day individually, providing a basis for effortless comparison and further examination. This snippet appears to be invoking a function named day of the week and supplying stockstuff as a parameter. The function likely processes the data within stockstuff to derive or present day of the week related insights. It is probable that the day of the week function involves tasks like examining the dates within the data frame to determine the respective day of the week for each date. This knowledge may serve to reveal patterns or trends within stock market data with respect to the days of the week. By utilizing this code, it becomes feasible to ascertain if particular days of the trading week exhibit specific tendencies or behaviors within the stock market. These observations could prove valuable for refining trading strategies, managing risks, or conducting comprehensive data analysis. This code appears to be invoking the function named day of the week with the argument stockstuff, which likely represents a data frame containing stock information. The function probably computes and provides a report or analysis based on the stock data for each day of the week. The purpose of the function could be to examine how stock performance varies across different days of the week, potentially uncovering trends or patterns that are unique to specific days. This analysis could offer valuable insights for trading strategies, investment optimization, or identifying factors that influence stock prices on particular days. In summary, this code plays a crucial role in conducting day-of-the-week analysis on stock data, aiding in understanding market behavior on specific days and supporting decision-making based on these observations. The code defines a function named daily analysis that takes a data frame diff as input. Within the function, an empty list called profit is initialized, and an empty data frame named difftemp is created. The function then iterates over the indices of the datetime column of the DataFrame diff in steps of 75. During each iteration, it slices the DataFrame diff into a temporary DataFrame called difftemp that contains 75 rows starting from the current index. The index of this temporary DataFrame is reset, the index column resulting from the reset is dropped, and the profit is calculated using a function or bassoon to be defined elsewhere. The profit value for each 75-row subset is added to the profit list. The function ultimately returns a list of the calculated profits. This code is beneficial for conducting analysis or performing calculations on large datasets by dividing them into smaller subsets for processing. In this instance, it calculates profits based on 75-row segments of data. Employing this method can aid in managing large datasets more effectively and mitigate potential memory issues that could arise when handling the entire dataset at once. The function yearly week analyzes takes a DataFrame diff as input and conducts yearly weekwise analysis on the data. It operates by defining a list of years from 2015 to 2022, setting up an empty dictionary called yearly report to hold the yearly profit percentages from the analysis. Within a loop iterating over the list of years, it filters the data for each year and resets the index of the resulting data frame. It then uses a function or bassoon to be defined elsewhere to calculate the profit percentage for each week in the year and saves these percentages in a list named profitpercentage. The weekly profit percentages are then added to the yearly report dictionary with the year as the key. The function ultimately returns the yearly report, which contains profit percentages for each week of each year present in the input data frame. This code is essential for analyzing stock data, sales data, or any other time series data on a weekly basis per year. It allows for data filtering, profit percentage calculation for each week, and enables performance assessment over time. It offers a structured approach to execute this analysis and retain the outcomes for subsequent processing or visualization. The provided code contains a custom function called yearly weeks analysis that likely performs analysis on a data frame named stocks. This function is designed to analyze the weekly performance of stocks within a year, possibly computing various metrics or insights. The function is invoked in the code, and the output is both printed and stored in a variable named yearly week report for potential further analysis or processing. This code snippet is valuable for examining stock performance on a weekly basis across different years. Such analysis can help uncover trends, guide investment decisions, or assess historical stock price behavior. It facilitates the extraction of insights and generation of reports based on stock data chronologically. This code defines a function called Calmar ratio that computes the Calmar ratio for a provided list of returns and a specified risk-free rate. The Calmar ratio is a key metric used by investors to evaluate the risk-adjusted performance of an investment or portfolio. The code operates as follows. 1. It sets initial values for variables like cumulative return, max drawdown, and pref peak. 2. The code then iterates through the list of returns, computing the cumulative return, drawdown, and continually updating the max drawdown and pref peak values. 3. Following the iteration, it determines the annualized return and ultimately calculates the Calmar ratio using this equation: annualized return risk-free rate max drawdown. Utilizing this code enables the computation of the Calmar ratio for a given set of returns, which is crucial for evaluating the risk-adjusted performance of an investment strategy or portfolio. The Calmar ratio, by considering both returns and drawdowns, offers a more holistic measure of risk-adjusted performance compared to solely analyzing returns or volatility in isolation. This code defines a function named Sortino ratio that computes the Sortino ratio, a metric for risk-adjusted return evaluation. The function takes two parameters: returns a list of investment or portfolio returns, and risk-free rate return rate of a risk-free investment like a government bond. Here's a breakdown of the function's operations. 1. It calculates the average return of the investment portfolio by summing up returns and dividing by the total count. 2. Downsides returns are identified by selecting only negative returns from the list. 3. Downside deviation is computed to measure the volatility of negative returns. This involves finding the average of squared differences between each negative return and the average return. 4. The downside deviation is determined as the square root of the computed average. 5. The Sortino ratio is calculated by taking the difference between the average return and the risk-free rate and dividing by the downside deviation. The Sortino ratio is valued for focusing on downside risk, particularly negative return volatility. It is seen as an enhancement over the Sharpe ratio since it penalizes only the downside volatility. This code is valuable for investors and financial analysts in assessing investment or portfolio performance concerning downside risk and the risk-free rate. The following code defines a function named Emax drawdown, which computes the maximum drawdown percentage from a list of prices. It conducts the following operations. 1. It initializes the variables Emax value and Emax drawdown to 0. 2. Iterates through the list of prices, starting from the second element. 3. Updates Emax value if the current price surpasses the prior maximum price encountered. 4. Computes the drawdown percentage between the current price and the highest price observed to date. 5. Revises Emax drawdown if the computed drawdown is lower than the current maximum drawdown. 6. The function ultimately returns the maximum drawdown percentage, which is then multiplied by 100. This piece of code holds significance in financial analysis and investment evaluation, aiding in grasping the potential losses that might arise in an investment. Drawdown acts as a metric for the decrease from the peak value of an investment to its lowest point before reaching a new peak. By determining the maximum drawdown, investors can gauge the risk associated with an investment and make well-informed decisions based on such insights. The following code defines a function named Sharpe ratio that computes the Sharpe ratio using a given set of returns and a risk-free rate. The Sharpe ratio is a metric that assesses the risk-adjusted returns of an asset by analyzing its performance relative to its risk level. It is calculated by subtracting the risk-free rate from the investment's return and then dividing the result by the standard deviation of the returns. For the computation of the Sharpe ratio, the function first determines the average return of the investment, the standard deviation of the returns, and the excess return average return risk-free rate. These computed values are then employed to derive the Sharpe ratio. Lastly, the function returns the resulting Sharpe ratio. This code is valuable as the Sharpe ratio aids investors in evaluating the risk-adjusted return of an investment, enabling them to compare various investment opportunities and make well-informed decisions regarding their portfolio. By encapsulating the necessary computations within a function, it provides a convenient method to calculate the Sharpe ratio in a reusable manner. The function average drawdown is designed to compute the average drawdown of a given list of prices. Here is an overview of how it functions. 1. An empty list called drawdowns is created to store the drawdown values for each price. 2. A variable named maxValue is initialized to keep track of the index of the highest price encountered so far. 3. The function iterates over the prices, starting from the second element. 4. For each price, it compares it to the maximum price seen so far. If the current price is higher, the maxValue is updated. Otherwise, the drawdown value is calculated as the difference between the current price and the maximum price seen so far divided by the maximum price seen so far, and it is added to the drawdowns list. 5. If no drawdowns are recorded, the length of drawdowns is 0. The function returns 0. 6. The average drawdown is calculated by summing all drawdown values in the drawdowns list, dividing by the number of drawdowns, and multiplying by 100 to get the percentage value. This function is valuable for evaluating an asset's performance by measuring its average drawdown. Drawdown signifies the drop from a previous peak in an investment's value to its lowest point before reaching a new peak. By computing the average drawdown, investors can gauge the risk associated with the investment and make informed decisions about its future prospects. This code processes the dictionary yearly report by extracting all its values and converting them into a list, which is then stored in the new variable yearly return report. This approach is beneficial when working with the values exclusively, without requiring the corresponding keys. By converting the values into a list, it facilitates easier manipulation and access to the values for subsequent processing or analysis. The provided code defines a function named corp2 that analyzes the profit percentage of a trading strategy known as Opening Range Breakout orb using a pandas data frame, likely containing financial data like opening prices, closing prices, high prices, low prices, and timestamps. The function executes the following steps. 1. It initializes various variables required for the calculation such as balance, equity, range roof, range floor, stop loss, profit margins, flag, and an empty dictionary to hold equity values at different timestamps. 2. It iterates through each row in the data frame, extracting information related to the opening range, stop loss, and profit margins based on specific conditions observed at particular timestamps. 3. Based on these extracted values and predefined trading conditions, it adjusts the equity through buying or selling actions at appropriate price points. 4. The function computes the profit percentage by evaluating the final equity relative to the initial balance and returns a dictionary containing equity values at different timestamps. By employing this code, traders and analysts can automate profit calculations for the orb strategy, enabling them to assess strategy performance over a specified period. This automated analysis aids in informed decision-making for future trading endeavors and enhances comprehension of this strategy's efficacy across diverse market scenarios. This line of code initializes an object named corb by calling a class or function called corb2 with the stock_diff variable as an argument. The specific functionality of the corb2 class or function will determine the behavior of this code. This code is likely intended to process or modify the data stored in the stock_diff variable to generate a new result or object. By utilizing functions or classes, the code can be structured for reusability, modularity, and easier maintenance. This approach aids in organizing the codebase and facilitates better comprehension and troubleshooting. However, without additional information about the implementation of the corb2 class or function, the exact purpose and operation of this code remain uncertain. The given code snippet accomplishes the following tasks. 1. It converts a dictionary named corb into a pandas data frame called DataFrame. 2. By setting currentIndex in the fromDit method, the keys of the dictionary are utilized as the data frame's index. 3. The index of the data frame is then reset. 4. The index column is renamed to datetime by employing the rename method with the inPlayTrue parameter. 5. The 0 column is renamed to value using the rename method with the inPlayTrue parameter. This code is beneficial when there is a need to transform a dictionary into a data frame and subsequently adjust the column names to accurately represent the data. It aids in structuring and organizing the data in a manner that enhances its usability, analysis, and visualization. The following command utilizes pip, Python's package manager, to install or update the Kaleido library. Kaleido is a Python package that enables the conversion of plotly charts to static images. This functionality proves beneficial when there is a need to store or distribute plotly plots as images, such as in reports, presentations, or websites. Executing this command guarantees that your Python environment is equipped with the most recent version of Kaleido, empowering you to effortlessly convert plotly charts to static images. This script generates an interactive plot of a data frame's data, with datetime values plotted on the x-axis and corresponding values on the y-axis. The interactive features include zooming, panning, and hovering over data points to view precise values. Utilizing this code is advantageous for data exploration and visualization, offering a user-friendly method to engage with the plot and extract insights more efficiently than static plots. The interactive nature facilitates a dynamic and in-depth examination of the data, proving especially valuable for large datasets or when seeking to discern patterns or trends. This code snippet utilizes the matplotlib library in Python to generate a line plot from a data frame named DataFrame. The datetime values are plotted on the x-axis with corresponding values on the y-axis, and the color of the plot is set to orange, using pult. Subplots fixes 12 for a figure and a set of subplots are created. The fixsize parameter specifies the dimensions of the figure in inches. The function plot is employed to plot the data, with datetime values as the x-axis and corresponding values from the data frame as the y-axis. The color parameter is set to orange to define the line color in the plot. Finally, the plot is saved as an image file named newplot. Ping with fig, save new plot. Ping. This step is commonly used to store or share visualizations for further analysis or presentation purposes. In essence, this code snippet is utilized to create a line plot from DataFrame data and export it as an image file using matplotlib, offering a visual representation of the data for analysis and sharing. The following code snippet utilizes the values method of a data frame in Python to extract all the values from the core.bif data frame and then stores these values as a list in the variable core.values. It is useful for separating the actual data from the row and column labels within the data frame. This code snippet can be beneficial when there is a need to independently work on or analyze the values from the data frame. For example, for conducting computations, applying filters, or transferring them to functions that expect a list of values. By converting the data frame values into a list, we enhance their manageability and enable more flexible and versatile operations. This code snippet creates a new list named temp that holds the values extracted from a dictionary named yearly week report. Here's a breakdown of the code yearly week report. Values. This part retrieves all the values stored in the yearly week report dictionary. List. This function converts the extracted values into a list and assigns it to the variable temp. This code is commonly used to extract and store only the values from a dictionary in a list format. This separation can be beneficial when specific operations or modifications need to be performed solely on the values of the dictionary without considering the associated keys. This code snippet flattens a two-dimensional list named temp into a one-dimensional list called returns. It achieves this by iterating through each element of temp and then iterating through the inner lists to append their elements to the returns list. By traversing each row of the to'd list temp and then each element within those rows, this code consolidates all elements of the to'd list into a singular one list. This code is particularly useful for converting a multi-dimensional list into a flattened list to streamline processing or analysis. It simplifies operations by consolidating all elements into a single list, eliminating the need to navigate through nested lists. The provided code utilizes specific functions Sharpe ratio, Calmar ratio, and Sortino ratio to compute and display the Sharpe ratio, Calmar ratio, and Sortino ratio based on the given returns and risk-free rate. These ratios serve as key metrics in finance for assessing the efficacy of an investment strategy. 1. The Sharpe ratio. This metric evaluates the risk-adjusted return of an investment by deducting the risk-free rate from the investment return and dividing it by the volatility of the investment returns. 2. The Calmar ratio. The Calmar ratio measures the return of an investment concerning its maximum drawdown and is computed by dividing the average annual rate of return by the maximum drawdown. 3. The Sortino ratio. Similar to the Sharpe ratio, the Sortino ratio centers on downside risk. Considering solely the standard deviation of negative returns, it is determined by dividing the excess return over the risk-free rate by the downside deviation. These ratios aid investors in comprehending and contrasting the risk and return attributes of various investment strategies or portfolios. By offering insights into the risk-adjusted performance of investments, they facilitate informed decision-making in the realm of finance. This code is likely invoking the function daily analysis and providing a data frame named stock.dif as input. The function probably conducts daily analysis on the stock data within the data frame and captures the results in a report stored in the variable daily report. The main objective of utilizing this code snippet appears to be automating the analysis of daily stock information, uncovering key insights, and producing a report. This approach enhances efficiency, maintains uniformity in the analysis workflow, and simplifies the process of analyzing stock data on a daily basis. By encapsulating the analysis logic within a function, it enables the code to be easily reused and promotes modularity. The provided code snippet is attempting to output the contents of a variable known as daily report. By displaying the daily report variable, the code aims to reveal specific data or information that was likely acquired or created earlier in the program. This printing action allows users or developers to visualize the content stored within this variable. Printing variables is an essential practice for debugging and communicating information clearly to individuals. It offers insights into data, results of operations, or outcomes of specific tasks conducted in the code. This practice is crucial during development to confirm the accuracy of processed data and validate the results of various calculations and procedures. This code conducts a thorough analysis of the performance of the orb opening range breakout strategy on different time frames. Here's an overview of the process. The code loops through dictionaries such as yearly report, yearly week report, and day of the week report to display the key value pairs relevant to each analysis. It then presents a daily report of the strategy, potentially summarizing data for each day within a specific period. Subsequently, the code calculates and showcases various performance metrics like Sharpe ratio, Calmar ratio, Sortino ratio, maximum drawdown, and average drawdown using functions like Sharpe ratio, Calmar ratio, Sortino ratio, max drawdown, and average drawdown, applying the data from the daily report. This analysis is crucial for evaluating the orb strategy's performance across different intervals and determining key performance indicators to gauge its effectiveness in producing returns relative to the risks involved. By scrutinizing the strategy's strengths and weaknesses, users can make well-informed decisions concerning its utilization and enhancement. This code snippet replaces all colons in the variable instrument with underscores and stores the result in a new variable called newInstrument. This code is useful for cleaning up data or formatting strings for better processing or display. It's especially handy when dealing with external sources or user input that may contain characters we need to modify or eliminate. While in this case we are specifically replacing colons with underscores, the same technique can be used to replace any characters or patterns within a string. This code snippet defines a dictionary named ZeroDha to store various financial metrics calculated from different functions applied to the data. These metrics include total return calculated using the orb function on the stock-stiff DataFrame, Sharpe ratio calculated using Sharpe ratio function with daily report and risk-free rate as inputs, Calmar ratio calculated using Calmar ratio function with daily report and risk-free rate as inputs, Sortino ratio calculated using Sortino ratio function with daily report and risk-free rate as inputs, maximum drawdown calculated using max drawdown function on the daily report data, average drawdown calculated using average drawdown function on the daily report data. Storing these metrics in a dictionary facilitates easy access and management of the calculated values within the code. This code is beneficial for financial analysis and performance evaluation in fields such as investment management or trading strategies where these metrics are essential for decision-making. The given code uses the items method on the dictionary ZeroDha to access its key-value pairs. This method returns a view object containing tuples of each key-value pair in the dictionary. By using this code, one can retrieve all key-value pairs from the ZeroDha dictionary as a list of tuples. This functionality can be valuable for debugging purposes or when needing to present the dictionary contents in a structured format. To utilize WeasyPrint, a Python package for rendering HTML and CSS to generate PDF and PNG files, the following code snippet can be used to install it using the Python package manager. Pip. WeasyPrint simplifies the conversion process by offering a high level of abstraction and streamlining PDF generation, allowing developers to concentrate on the content transformation without needing to delve into the intricacies of PDF creation. The following code snippet showcases the Python-docx library's functionality to generate a new Word document and populate it with text. It utilizes the document class from the docs module to create a fresh Word file and employs the CAD heading and CAD paragraph methods to incorporate headings and paragraphs into the document. In this instance, the script includes a heading and several paragraphs that delve into the opening range breakout concept in trading. It elucidates the strategy of utilizing the high and low values of the initial candle as range limits, defining profit margins according to the range, executing stock trades based on breakout direction, establishing stop-loss levels, and adjusting ranges for subsequent candles to effectively manage trades with a favorable risk-to-reward ratio. Such code is particularly valuable for automating the generation of Word documents containing dynamic content produced by a program or conveying detailed explanations or instructions in a document format. It facilitates effortless customization and control over Word documents through Python code manipulation. You can install the reportlab library in Python using the pip package installer. Reportlab is a Python library that enables the creation of PDF documents with features such as charts, graphics, and tables. By running the following command, you can effortlessly set up the reportlab library and leverage its capabilities to produce bespoke PDF documents within your Python programs. Executing this command in the terminal or command prompt initiates the automatic download and installation of the essential files and dependencies for reportlab, enabling you to start utilizing PDF generation in Python promptly. This Python script utilizes the reportlab library to generate a PDF document detailing the opening range breakout trading strategy. The code includes the following functionalities: 1. Importing necessary modules from the reportlab library like canvas, simple doc template, paragraph, table, image, etc. 2. Defining a document title variable to set the document title. 3. Creating a list called paragraphs that contains multiple paragraphs describing the opening range breakout strategy. 4. The paragraphs explain the strategy's approach in various trading scenarios, including bullish and bearish markets, and offer guidance on selling, buying, stop loss, taking profit, and managing risk in trading. This code enables the generation of a well-structured and formatted PDF document that outlines the key details and recommendations for implementing the opening range breakout trading strategy, suitable for reference or distribution purposes. This function, Corp Daily, implements the opening range breakout orb strategy by analyzing historical data of a financial instrument within a specified time frame. Here's a summary of its operation. 1. It sets a time interval 9:15 a.m. to 3:30 p.m. for the specified date. 2. Gathers historical data for the financial instrument within that time frame and period. 3. Examines the data to generate buy or sell signals based on high and low price comparisons with the opening range floor and roof. 4. Calculates profits by considering entry and exit prices during the trading session. 5. Adds the trading outcomes: entry time, entry price, exit time, exit price, profit to a results data frame. 6. Ultimately, it returns the results data frame containing the trading signals and profit loss details. This function streamlines the backtesting and evaluation of the orb strategy for various financial instruments and dates, aiding traders in making well-informed decisions on their trading strategies. The provided code demonstrates how to view the first 75 rows of the results data frame. By utilizing the head function in Pandas, users can gain a concise overview of the data stored in a data frame by displaying the initial entries. Employing this code is crucial for swiftly examining extensive datasets, comprehending their layout, and verifying the accurate loading of data. This approach offers an initial glimpse into the data frame's content, aiding in decision-making regarding data manipulation, refinement, analysis, or visualization. This code snippet utilizes the plot function to create an interactive plot. Specifically, it plots the exit time column values on the x-axis and the profit column values on the y-axis from the data frame result. The plot function leverages the plotly library in Python to generate dynamic plots. Interactive plots enable users to zoom, pan, hover over data points for details, and more. This functionality is advantageous for exploring data and extracting insights from visualizations. Employing interactive plots with a plot proves beneficial when visualizing data in notebooks or web applications, as it allows users to interact with the data to comprehend trends and patterns effectively. The code includes a function named getWeekDayDates that accepts two parameters: start date and end date. This function produces a list of dates falling on weekdays Monday to Friday between the start date and end date, including both boundaries. The function creates an empty list called weekday dates to hold the weekday dates. It iterates over the range from start date to end date and checks if each date is a weekday denoted by a weekday value less than 5. If a date meets this condition, it is added to the weekday dates list. The function ultimately returns the list of weekday dates after processing all dates in this specified range. This code is particularly useful in scenarios where filtering and processing weekday-specific dates within a specified period is necessary. It can be applied effectively in situations where weekends need to be excluded or specific tasks or to be executed exclusively on weekdays. The function getFullData requires 4 parameters: start date, end date, instrument, and time period. Here is how the code works. 1. It first uses the getWeekDayData end date function to obtain a list of weekdays between start date and end date. 2. An empty data frame named unicondiff is initialized. 3. The code then loops through each date in the obtained list of weekdays. 4. For each date, the orbDaily function is called with the date, instrument, and time period as arguments. This function likely computes values following the open range breakout strategy for the given date, instrument, and time period, and returns a data frame template. 5. The template data frame is then concatenated to unicondiff row-wise using get onAt, ensuring a continuous index with ignores index truths. 6. Finally, the function returns the union of data frame containing the consolidated data from each date processed through the corp daily function. This code facilitates the aggregation and combination of data from multiple dates into a unified data frame. It is commonly used in financial analysis and trading strategies to combine historical data from various dates for analyzing patterns and trends. This code snippet is designed to fetch comprehensive data for a specific financial instrument within a specified time range. Here is a breakdown of the parameters involved. A start date indicates the beginning date from which data retrieval should commence. A end date specifies the end date until which data should be collected. A instrument represents the financial asset such as a stock, currency pair, or commodity for which data is to be retrieved. The time period indicates the granularity of the data being fetched, such as daily or hourly intervals. Utilizing this code is crucial when there is a need to gather historical or real-time data for analysis, visualization, or other financial purposes. This data can be utilized for trend analysis, forecasting, and various forms of financial analysis to aid decision-making in the realms of finance and investment. The method full data info is utilized to provide a brief overview of a data frame. It presents details regarding the data frame's columns including names, data types, the count of non-null values, and the memory usage. This summary is valuable for grasping the data frame's layout, identifying missing data, and gaining insights into the data types across columns. It streamlines data exploration, cleaning, and preparation efforts prior to subsequent analysis or processing.